In this video, I'll answer your money and investing questions, and we're starting right now. Hey guys, Elliot here. So this is the first of what I hope to be a regular feature on my channel, and it's going to be a money and investing Q&A. Now these are just questions that I've gotten over the years being a financial advisor and a financial educator. So if you have a question on money and finance, drop it in the comment section below, or you can just email me through the channel, and I will cover it in an upcoming edition of this Q&A. As always, if you enjoy the content and find it useful, please do subscribe to the channel, helps me out a lot, and don't forget to smash that like button. Alright, let's grab the questions and get right into it. Okay, let's start with the first question, and it's how do I invest as an absolute beginner? Okay, I get this one a lot. So how do most people start investing these days? Well, they hear about some hot stocks by talking about it with friends or coworkers, and then they're like, let me try to buy some of these, see if I can make some money, and they open up a brokerage account, typically Robinhood, and then they see if their stocks go up or down, and you usually get pretty mixed results. Now, there's nothing inherently wrong with this, but let's face it, this is not really investing, this is speculating on price. Investing involves a certain amount of discipline, strategy, and consistency, and it's something you do for the long haul. So it's at that point that I have folks come to me and say, okay, how do I get serious about investing, because this whole picking and speculating on stocks is not really working out. So here's what I typically tell them. The first thing you should do is take a look to see if you have a 401k at your place of employment. Now 401ks are of course tax advantage retirement accounts, and I have a few videos on them on my channel if you want to learn a little bit more. Now sometimes companies match your 401k contributions, and if you have that, definitely sign up because it's essentially free money. Now besides the 401k, check to see if your job has an IRA, which is an individual retirement account. This could be either a regular or a Roth IRA. Either way, check to see if you have that. If your employer does not, you can totally set this up on your own through a brokerage or even a bank. IRAs are also tax advantage retirement accounts, and they're a great tool just like the 401k. Now, if you've done all that and you want to continue investing, what is step number 2? What I always recommend is to invest in index funds. These can be mutual funds or more typically ETFs or exchange traded funds, and I do have a lot more on my channel about these if you want to get into some details, but essentially they are funds that track an index, and they invest in the same stocks in the same proportions as the index, and the index typically followed as the S&P 500, which is a great representative of the entire investing stock market. And what you're doing is essentially investing in the market. Now index funds are very easy to invest in. First of all, they're very low cost. There's no management fees. You don't have to pick stocks because they follow an index, and the returns are usually pretty good. Why? Because they follow the S&P 500, and historically the index has returned about 10% per year. Now there's certainly been down years and up years, but if you're investing for the long haul, this is what historically the S&P 500 has been returning. Okay, now if you've already invested in the 401k, an IRA, and some sort of index funds, and you still have money left over to invest with, it's only then that you should get into the wider market. When you do, you should really pick a strategy. Do you want to be a value investor, a growth investor, a dividend investor, or just pick stocks by hand? So that is the order I recommend beginners to start. 401k, IRA, regular or Roth, then the index funds, and then finally venture into the wider market and try picking stocks, or even get into more advanced stuff like derivatives, options, and whatnot. But the point is, don't get into this in the reverse order. Don't pick stocks randomly first and then set up the more solid investing foundations like 401k or IRA. The order does matter. Okay, question number 2 is, can you pick stocks for me? So the short answer is no. That's not really what financial advisors and educators do. We tend to focus more on bread and butter investing issues, mostly having to do with retirement, portfolio management, things like that, with some advisors venturing into life insurance or asset management and asset protection even. But either way, picking stocks is really not part of the job description. Now, having said that, there are people that analyze and pick stocks for a living, and they're called analysts. Many of them are employed by managed mutual funds, and what they do is they specialize in a sector of the economy, they learn a lot about it, and they advise the fund on what stocks to buy from that sector. Now, how can you gain access to this knowledge? Well, there's one very simple way. You can go to any fund you're interested in, perhaps one that's doing really well, and see what stocks it invests in. By law, the fund has to list every single one of its holdings, and if you want to duplicate it, market, you can essentially buy what the fund buys and benefit from what its analysts recommend. Now, a lot of analysts also write articles in various online publications or forums, and you can get access to their knowledge by reading what they recommend. Now, of course, always take this with a grain of salt, because truly no one knows 100% where a stock is going. So I read these as well, but I use them as more of a way to learn about new companies, because I sure as heck don't know all of them. And I read these and I'll say, oh, this is kind of an interesting company. And then I go do my own research. And that's the key there. Do your own research. Don't rely on any analyst's analysis, because, they're only human. And while they have a very educated analysis, they could be wrong. So the bottom line is that's where you should get stock picking advice, and not from a financial advisor or educator. Okay, the third question is, why is the stock market up when the economy is down? Okay, this one causes a lot of confusion among non-investors. And what I'm specifically referring to is the situation a couple of years ago when the COVID-19 pandemic really took hold. People were losing their jobs and companies were closing down, yet the stock market was red hot. What the heck was going on? Why was there such a disconnect between Main Street and Wall Street? Well, if you take a closer look, what was going on was actually fairly rational and understandable. And to really understand what was going on, you had to look at the broader economy and the role of the Fed. You see, when the economy slows down, the Fed springs into action by cutting interest rates, sometimes all the way down to zero, and this in turn helps stimulate the economy. How does it do it? Well, the borrowing costs decrease quite a bit, and this in turn allows the companies to borrow cheap capital to hopefully invest it in their business and hire more workers and get the economy spinning again. This is all fine and good and works reasonably well. However, extremely low interest rates cause a whole new set of problems for the investors. You see, when the rates are so low, there is a limited number of things you can put your money in. You certainly can't put it into savings accounts or CDs or money market accounts, because their rates are rock bottom. Bonds aren't a really good option either, because their interest rates sink as well. So what do investors have left? You guessed it, the stock market. And investors who would ordinarily park their money elsewhere all flock to equities. Now, that's the first part of the equation. The second part is the influx of cash. What I mean here is, A, you have a lot of people who did not lose their jobs and have a lot of spare money laying around, and their savings have grown tremendously because they can't really go out or travel or spend it on really anything. And B, you have a lot of people who've gotten stimulus checks, so they now have a lot of spare cash laying around. Now, the third part of the equation is more has to do with human psychology. People are sitting at home and they have cash and they don't have a whole lot to do, and some of them perhaps like to gamble, and perhaps some of them just said, hey, I want to learn about the stock market. I got plenty of time. So the net result of millions of people feeling like this is that they end up turning to the equities market, whether it's to replicate the thrill of gambling because they can't get to the sports or a casino, or they just want to invest finally and they've been putting it off and now they have the time and some extra cash. Bottom line is there's tons of people now investing, and what happens when you put money into the stock market? It goes up. Now remember also, not all companies did bad. A lot of them did very well during the pandemic, especially ones that specialize in deliveries or various online services. So there were plenty of places to park your money and invest. Now, to recap all of this, so the stock market was up because A, interest rates were very low, there was nothing else to put money in. B, a lot of people had extra cash, and either from savings or from stimulus. And C, everyone wanted to jump into the stock market, either from boredom or to replicate the high from gambling. And finally, there were a lot of companies that were doing well, and there was plenty to invest in. All right, question number 4 says, all the stocks I want to buy are expensive. Can I buy a fraction of a share? All right, this is a great question for folks who want to buy shares of usually a tech company whose stock is outrageously expensive. Now, here's 3 that I checked recently, and they are for Amazon, Alphabet, the parent of Google, and Tesla. And their share prices were $3,300 for Amazon, $2,800 for Alphabet, and $1,000 a share for Tesla. And this information is from about a week or 2 ago. Now, yeah, they're priced out of reach of a lot of investors, so the question is, can you buy fractional shares? So the short answer is that the companies themselves don't put fractional shares on the market. You can get fractional shares through a broker. And you can probably imagine how this works. The broker buys whole shares and then subdivides it and sells fractional pieces to their their customers. So this wasn't as common before Wall Street got fully computerized, but now almost every broker offers this. You could also get fractional shares through something called a DRIP or a dividend reinvestment plan, but this is often run through a company. So if you want a piece of Amazon, Alphabet, or Tesla and can't afford an entire share, then yes, go see a broker. Most of them offer this, and ask to buy fractional shares. Alright guys, I hope you enjoyed this first financial investing Q&A. I hope to have quite a bit more of these. I have a lot of questions that I've collected over the years, but you can also help by leaving questions in the description below, or just emailing me through the channel. Thanks for watching, and I'll see you guys soon.